So the reason why we need to understand the previous sections, which show you the efficient frontier, the capital asset line, and the difference curves, is because this leads us to the capital asset pricing model. Okay, so what happens? The capital asset pricing model is a model that actually allows us to price um, any asset, and it's actually really based on the concept of market portfolio. The capital asset pricing model makes several assumptions. So first of all, the markets for securities are all competitive and they're all equally profitable to all investors. Okay, so basically what happens is that all investors are in an even playing ground, so that no investor is so wealthy that his or her actions can automatically disrupt the investment market itself. So in essence, like when we compare this to something like cryptocurrency, we heard of this concept like whales, right? There are these crypto whales who could actually, put in a lot of money into Ethereum or Bitcoin, and that would affect the prices. Okay, so that means we're actually making the assumption that even large investment companies like BlackRock aren't so large or aren't so wealthy that when they actually make an investment, that they can actually push market prices from the equilibrium. Okay, so basically, some might actually say that this assumption A might not be realistic because we do know that institutional investors do have a lot, but fundamentally, this is one of the CAPM assumptions anyway. Okay, otherwise, if you void these assumptions, then the CAPM doesn't hold. All right, so the CAPM is really a methodology that's required that needs its assumptions that allows us to price any type of asset. Okay, Part B also shows that all information relevant to an analysis of the financial security is publicly available at no cost. Now, we also know that this is a pretty tough assumption to make, fundamentally because we know that if you want access to Bloomberg, you have to pay for it. If you want access to Capital IQ, which has more, which also has very robust and rigorous analysis on the platform, you have to pay for it. So it's not really true that any information relevant to security analysis is publicly available at no cost. It actually does cost you money to have good information. So the third assumption is that all securities are publicly owned and traded, and investors can trade in any and all of them, right? So all risky assets are in the investor universe. Now we know that this is, also a tough assumption to have because we also have private companies, not just public. So basically, we do know that when we invest on the stock market, on the ASX, that only includes all publicly traded assets in Australia, but it doesn't actually necessarily include those in the US. So we also make some other assumptions like there are no taxes on investment returns and that investments have no transaction costs that could actually stop you from trading, and that we can lend and borrow at a risk-free rate in an unlimited fashion. What this means is that we're saying that a bank would allow us to lend at a risk-free rate if we want to lend up to even like $1 million or $10 million, which we know that this is simply not true. Okay, so I know it sounds like I'm being a bit depressing about the CAPM, that it has all of these unrealistic assumptions, but basically it is a very straightforward mathematical model that's actually used to underpin the pricing of stocks, especially to actually work out what the appropriate discount rate is for a share. So so don't be don't be like let down by the fact that some of these CAPM assumptions are not realistic, but we do have to make lots of assumptions in any mathematical model, okay, in order to have it to hold true and to actually use it in a functional, pragmatic fashion. Okay. So as mentioned before, when we look at investors are being alike in every way except for the initial wealth and risk aversion, they can all choose investment portfolios in the same manner. So in this sense, the other sub-assumptions in this are that investors are rational mean variance optimizers. So what this means over here is that all they care about for investors is that they only want to maximize their mean return and minimize their variance. However, we have also spoken about this in the class whereby investors are not necessarily rational, they are often irrational, and variance actually treats upside gain and downside loss in the same fashion. We do know that in truth, according to behavioral finance, investors are irrational, that we actually treat a $100 loss emotionally greater than a $100 gain. We're also assuming that investors are planning for the same horizon. So that means everyone be planning to retire at the same point in time when they're 60 years old, which, this is another assumption which isn't quite realistic. We also consider that all investors are efficient users of analytical methods, like what you're learning here in this subject, okay, and have access to all relevant information, that they will all consider identical portfolio opportunity sets. So they call this homogeneous expectations. So that means everyone has the same expectation of what's going to happen in the future. So as mentioned, there are a lot of assumptions to the CAPM, so we just want to let you know what they are, as this would explain to you that when these assumptions are violated, then fundamentally, essentially, that might actually tell us why sometimes the CAPM doesn't price assets in an exact and precise manner, but it is a very, very good starting point. So what we can conclude about the CAPM is that the market portfolio is the optimal risky portfolio on the efficient frontier. So as mentioned over here, the efficient frontier is that curve line that we had, and the market portfolio is any risky portfolio that sits on the frontier. So what we do now is that for the market to clear, that we have the total number of shares outstanding must aggregate the holdings of all investors. That gives you the market portfolio. Okay, and then for investors, the Markowitz optimization model, which we'll talk about a bit more, but have the same input parameters, and that gives us the same optimal risky portfolio via the separation property. So the market portfolio ultimately has the same weights as the optimal risky portfolio. So as a result, what based on all these assumptions, what does the CAPM imply? So the CAPM really just implies that the optimal portfolio for all investors is a combination of the risk-free asset and the market portfolio. So going back to the previous set of slides, that was actually what we're referring to over here, okay? That it's made up of the market portfolio given by the efficient frontier and the risk-free asset. So the optimal complete portfolio sits on that line. So what actually happens from there is that there's no other risky portfolio better than a market portfolio. So based on this theoretical concept, right, one shouldn't just invest in certain types of securities or stocks, or like a tech stock or a utility stock. You should actually invest in the entire market. Henceforth, there's been a huge growth in index funds, which are like exchange traded funds, particularly those that actually are there to mimic an index. For example, the largest index fund, largest ETF from BlackRock is known as IVV. So basically, let me show you what that is over here. So the flagship ETF of BlackRock is iShares Core S&P 500. So basically, it quite clearly says that the goal is to actually track the investment results of the S&P 500, which consists of the largest S&P 500 stocks in the universe. So we've seen like a huge growth in index funds. And that's actually because we have a lot more people who actually look into financial theory, and they realize, okay, that theoretically, most hedge funds or fund managers are unable to beat the market portfolio in the long run. And theoretically, it is actually the most efficient optimal portfolio to purchase. So therefore, the expense ratio of the iShares 500 ETF is actually very, very low compared to other funds. So let's go back to the CAPM. So over here, this actually means the CAPM actually allows us to price individual assets. Because basically what happens is that we should not be compensated for idiosyncratic risk. One should only compensated for market risk. So therefore, the risk premium on individual assets is proportional to the market risk premium. So what we see over here, the expected return on asset I, any stock, minus risk rate equals to beta, which is known as the beta coefficient or the risk coefficient, where we have the risk premium is given by the expected return on the market portfolio minus the risk-free rate. So beta is the covariance between the asset I and the market portfolio divided by the variance of the market portfolio. So let's have a look at that again. So the risk premium on an individual asset. So this is the risk premium and this is the individual asset because it's a risk premium because it's the expected return on the asset minus the risk-free rate equals to the covariance or the beta coefficient of the market risk premium. So this over here is the market risk premium, where it's the expected return on the market portfolio minus risk rate. So this is the market risk premium. So the expected return on an individual asset is proportional to the market risk premium, and when the value of that proportion is given by the covariance between the risky asset and the market portfolio divided by the variance of the market